3.
Assalamu alaikum, dear students. I am Sadia Hussain, lecturer, Department of Finance. Dear students, today we will learn about Chapter 9, Risks and Return, which is from first paper. In every business investment, one of the most important topic is risks. That means risks is related with every business decision. At first, we have to understand what is investment. In finance, an investment is the monetary asset purchased with the idea that the asset will provide income in the future or will later be sold at a higher price for a profit. And second one is return on investment. We can call it as ROI. What is return on investment? It is a financial ratio used to calculate the benefit an investor will receive in relation to their investment cost. It is most commonly measured as net income divided by the original capital cost or cost of capital of the investment. The higher the ratio, the greater the benefit will earn. And from that return on investment, one is capital gain and second one is capital loss. When an investor sold an asset higher than its purchasing price, then he will receive capital gain. Again, what is capital loss? When an investor sold an asset lower than its purchasing price, then he will face capital loss. And our today's second topic is expected return. The expected rate of return is an anticipated value expressed as a percentage to be earned by an investor during a certain period of time. This concept is a future-based concept, and this concept is assumed or calculated by the prediction. And second one is realized return. What is realized return? The return that is actually earned over a given period of time. And our today's final topic is concept of risks. Risk is defined as a chance that the actual outcome from an investment will differ from the expected outcome. We can measure the risk through standard deviation and coefficient of variance. Now we will see some types of risks. First one is business risks. A business risk is the inability to cover a firm's or organization's operating cost. That means office rent, utilities expenditure, wages, or raw material purchasing case. When a firm faces difficulties or inability to cover this type of expenditure, then they will face the business risks. And second one is financial risks, which is related with the liability. That means loan or debt. The higher the liability increases, the possibility of financial risks will be increased. And third one is interest rate risks. When the market situation changes, then the financial securities interest rate changes, and it faces interest rate risks. And fourth one is liquidity risks. Liquidity risks means the inability to cover up or the inability to convert financial securities into cash, which is called liquidity risks. And fifth one is systematic risks. Systematic risks is that part of the total risks that is earned by factors beyond the control of a specific company or individual. This type of risks is non-diversifiable. That means systematic risks are market risks, interest rate risks, inflation risks, which all are under market or system. We cannot change, we have to just face it. And our today's last topic is unsystematic or non-systematic risks. Unsystematic risks, also known as diversifiable risks, that means we can easily cover or we can change it, is the danger that relates to a particular security or a portfolio of securities. Dear students, that's all for today's class. Allah Hafiz.